Hey everyone, welcome back to Mitchell Marcus. Today we are going to be going over gamma squeezes, how they happen, what to look out for, and how you can be on the winning team when it comes to gamma squeeze setups. Most traders have heard the term gamma squeeze, but very few understand the actual categories of why it happens or how to identify one before it triggers. Today we're going under the hood. This is going to be the real mechanics of a gamma squeeze, the math, signals, and exactly how to trade it. Let's get into it, guys. A gamma squeeze is a feedback loop, and it starts with market makers. When you buy a call option, someone has to sell it to you. In most cases, as a market maker, a firm whose job is to provide liquidity. When a market maker sells you a call, they are now short a call option. They have negative gamma. To stay delta neutral, meaning not carrying a directional bet on the stock, they immediately buy shares of the underlying as a hedge. And here's where it gets important. As the stock price rises, the delta of that call increases. Gamma is what drives the increase. So as the stock climbs, market makers' hedge becomes insufficient. They have to buy more shares to reestablish delta neutrality, and that buying can push the stock higher, which increases delta even further, which is going to force more buying. In that self-reinforcing cycle, call buying is forcing stock buying, forcing more call buying and stock buying. Let's put real numbers on this so you can see what is actually happening. When a market maker sells a call, the number of shares he needs to hold as a hedge equals the delta of that option multiplied by the number of contracts times 100 shares per contract. At the money, that delta is around 0.52. So for every 1,000 call contracts sold, the market maker holds approximately 52,000 shares as a hedge. Now the stock moves up $2 to 102. Gamma accelerates the delta to 0.74. The market maker now needs 73,000, almost 74,000 shares to stay delta neutral. They're forced to go buy over 21,000 shares immediately. Multiply that across every strike with open interest, and you can see how a moderate stock move forces enormous share buying from dealers. The stock does not need retail momentum to start squeezing. The hedging obligation alone can drive it. The tool you need to measure at each strike is called GEX, gamma exposure. GEX tells you exactly how many dollars of stock market makers are forced to buy or sell per $1 move in the stock price. The formula is gamma multiplied by open interest multiplied by 100 multiplied by the stock price. You calculate it at every strike and then sum them. For calls, GX is positive. Dealers are short calls, so they buy stock as price rises. For puts, GX is negative. Dealers are long puts, so they sell stock as price falls. When you map net GX across all strikes and sum them cumulatively, you get the gamma flip level. That is the exact price where total GX crosses from negative to positive. In this example, that flip happened between 100 and 103, approximately 101 to 102. Below that level, dealers are net short gamma, so it amplifies every move. Above that, the cumulative turned positive and it starts to stabilize. But here's the key. Right above that flip sits the biggest call open interest wall, concentrated at 103 and 106. That is $14 million of call GX. Once the stock clears the flip level, dealers are forced to buy straight into that wall. That is what turns a normal move into a gamma squeeze. So how do you identify a gamma squeeze before it triggers? You're looking for four things simultaneously. First, Large call open interest concentrated at strikes above the current price. The bigger the open interest, the more dealer hedging gets forced when the stock price approaches those strikes. Second, the stock is trading near or just below the gamma flip level. That is the tripwire. A break above it flips dealer behavior from dampening to amplifying. Third, elevated short interest above 15% of float. A gamma squeeze and a short squeeze can stack directly on top of each other. When dealers are forced to buy and short sellers have to cover at the same time, it becomes violent. A tight float with 20 million shares outstanding cannot absorb hedging. With fewer shares available, the more impact forced buying has on price. Tools like Spot Gamma and Market Chameleon publish EX daily. You are looking for setups with the flip level being close, short interest above 15%, and there is a wall of call open interest just above. Thank you guys so much for watching. I have some more videos coming up pretty soon. Been super busy, so been difficult to take deep dives in the option trading with a lot going on, but more videos are coming out soon. Enjoy, make sure to like, subscribe, comment what you would like to hear more about in the next Metro Market video.